You know, when you hear the name Clorox, you probably think of that iconic bottle of bleach, right? It's a staple. It's been in our homes for generations. It's a brand that's just built on trust and reliability. It feels safe, stable, like a sure thing. But today, we're going to peel back the label and look at the numbers. And let me tell you, what they reveal is anything but stable. Because while the brand itself feels as solid as ever, the company's stock has been telling a completely different and, frankly, a much more concerning story. So let's just dive right into the hard numbers. And here it is, the big headline problem. The total return for investors has been deeply, deeply negative. I mean, we're looking at a 28% loss over just the past year. Ouch. And even if you zoom out and average it over 5 years, investors are still down. For a company that's supposed to be a safe, defensive stock, these are some seriously alarming figures. This immediately begs the question, right? What on earth is going on here? Why is a company with such a powerful, trusted brand struggling so much from an investment point of view? Let's unpack the case for concern. Okay, we're going to approach this like a detective story because there are really two conflicting narratives. First up is what we'll call the bear case. These are the data points that are giving investors some serious pause and are really fueling this downturn. And here's issue number one. The company's sales, they're shrinking. Over the last 5 years, on average, revenue has actually declined by over 2% every year. Think about that. While other companies are trying to grow, Clorox has been getting smaller. For any investor, that is a fundamental red flag. Now, as we dig a little deeper into the financials, we run into some metrics that, on the surface can look downright terrifying. It's pretty easy to see a number like the one on our next slide and get, well, pretty worried. Yeah, you are seeing that right. A price-to-book ratio of -95. In simple terms, this means the company's liabilities are actually greater than its assets on the books. Now, hold on. While that can be a massive warning sign, for a mature cash cow of a company like Clorox, it's often the result of something else entirely, decades of buying back its own stock. So it's a really confusing metric, for sure, but it's not necessarily the sign of disaster it first appears to be. So we've got shrinking revenues and a really confusing balance sheet. Case closed, right? The company's in trouble. Well, not so fast, because this is where our story takes a very sharp turn. If you only look at that negative data, you miss a completely different and far more positive side of the story. So now we're going to pivot to the bull case. This is the side of the story that really highlights Clorox's incredible underlying strength, and it stands in stark contrast to everything we've just seen. And wow, this single number right here, it captures the other side of the story perfectly. For 48 straight years, Clorox has increased the dividend it pays to its shareholders. 48 years. Think about that. Through recessions, market crashes, global crises, you name it. That isn't just consistency. It's a testament to a deeply reliable, cash-generating business machine. And when we look at how the business actually performs at its core, the numbers are just exceptional. A return on equity over 600 is, well, it's astronomical. It shows an incredible efficiency in generating profit from shareholder money. And a return on invested capital over 21%, that's considered elite. So this tells us that even with shrinking sales, the underlying business is an absolute powerhouse at turning capital into profit. And this isn't just a story about past strength either. In just the last year, while revenue was down, net income, the actual profit, has soared by over 65%. This suggests the company is becoming much more efficient and profitable even on lower sales. That is a very powerful recent trend. Okay, so we have two completely different stories, don't we? A company with shrinking sales but an incredibly profitable core and this fantastic dividend history. So how in the world do we make sense of this? Well, we turn to valuation. We try to figure out what the company is actually worth. This slide gets right to the heart of it. The market right now is pricing the stock at about $98. However, a really common valuation method, basically a model that estimates a company's worth based on its future cash, calculates a fair value of over $112. This suggests the market may be focusing way too much on the shrinking sales while totally ignoring that powerful profitability. This chart right here just shows you how much market sentiment has shifted. The price-to-earnings ratio tells you how much investors are willing to pay for each dollar of a company's profits. Right now, that number is about 16. But look at the average over the last 3 years. It was almost 72. Investors are paying dramatically less for Clorox's profits today than they were in the very recent past. So where does all of this leave us? Well, Clorox is clearly a company at a crossroads, and it's presenting two very distinct faces to the world, depending on which data you want to focus on. So here they are, the two narratives, side by side. The bear case is pretty clear. Falling revenue, poor stock returns lately. But the bull case is just as compelling. You've got this elite dividend history, a fantastically profitable core business, and a stock that really appears to be trading below its fair value. And that brings us to the final million-dollar question, doesn't it? Is this a classic value trap where the low price is totally justified because the business is just in a permanent decline? Or is this a coiled spring, a really high-quality, profitable business that has been unfairly punished by the market and is just waiting for sentiment to shift? Based on all the data, the answer isn't obvious at all. And honestly, that's exactly what makes it so fascinating to watch.